Hello and welcome to this very special show, Building Wealth Through Gold, the ETF Edge, brought to you by Outlook Money in association with ICICI Prudential AMC. Gold has always been India's favorite investment, but as markets evolve, so do investor choices. Today, buying gold doesn't necessarily mean visiting a jeweler, it can mean a few clicks on your phone. We are talking about gold ETFs, the modern investor's way to hold gold, trade it, and even use it to hedge against inflation. To help us understand how ETFs are redefining gold investing, I have with me Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Mr. Vivek Goel, Founder and Joint MD at Tailwind Financial Services. Gentlemen, welcome to the show.
Ankita.
Hi, Ankita. Thank you.
Chintan, let's begin with you. Diwali is round the corner. This is traditionally the time when Indians buy gold, especially on Dhanteras. But we now see informed investors choosing gold ETFs over physical gold. Does this switch really make sense to you?
Thanks, Ankita, and wishing all the viewers and listeners of Outlook very happy Diwali. I think the switch from gold to gold ETF is just a matter of convenience. And it's great that our ancestors actually gave us the legacy of holding gold because, as you would have seen, out of the $12 trillion out of wealth that India has now, courtesy the rise in gold, as per latest reports, $3.8 trillion is held in gold. Most of it is in physical form. So while you did mention that gold ETF as a category is picking up and it's a new way of investing, it is also something which is convenient way of investing, and you can invest it over a period of time without having to physically go to the jeweler and actually take the gold. So while jewelry will always have its shine, but gold ETFs in terms of financial investment make a lot of sense. Sovereign gold bonds were the best way to invest in gold, of course, for most, if you didn't have to worry about too much about liquidity. But since government is not issuing sovereign gold bonds anymore, you can either buy them on the exchange or otherwise gold ETFs. There's no limit as such in terms of how much you can buy. And it's convenient. You can buy it in smaller unit sizes as well. So I think for the entire spectrum of investors, if you are looking to add gold ETFs do give its own shine. It's easier than physical gold. And also you don't have to worry about purity, security, and saving it somewhere. We are doing that for you in terms of the AMCs in a more secure manner, and it is fully regulated by the regulator. So I think it works well for investors.
Oh, okay. So, Chintan, for someone who's always thought of gold as something you wear or store, this can sound very abstract. Could you explain what gold ETFs are and how they actually work?
Sure. So what is essentially gold? Gold is a commodity which you typically would go and buy. You give money, you buy gold from the jeweler or the distributor or the dealer. In gold ETFs, you really don't need to physically go anywhere, much like how you buy a share or you buy equity on the markets, on the exchanges. You buy units of the gold ETF. And what are these units of the gold ETFs? These units of the gold ETFs are nothing but backed by physical gold, which is stored in volts. So a high purity, high quality, which is standardized, which is 999.9 or 999.5, which is stored at the back end in the volts, managed by the asset management company of whose ETF you're buying. And that basically disintermediates, or it does not require you to go physically somewhere. And of course, for that particular gold ETF, there is a certain charge that the asset management company charges you, but it kind of is ensuring that it is insured, it is of good quality. And the good part is now if you hold for more than 1 year, the gold ETFs also have a taxation, which I think Vivek will cover in detail, which is also favorable for investors. So from an investor standpoint, both gold ETF and silver ETF are simply ways of actually getting access to physical gold or physical silver without necessarily holding it physically, because you're getting it in unit form, much the same way as you buy equities. The gold is there, the silver is there. It is stored in the vaults. All that we are doing as an asset management company is converting them into units and giving it to you in the unit form so that you don't have to worry about the security or saving of the gold. And those units you can freely trade as and when you want. It's quite convenient as well. And more importantly, you can do it even in smaller quantities or smaller units, because I think one unit size would be anywhere between 100 to 200 rupees, depending on which ETF you pick. So it's convenience all around.
Okay, so in essence, I can buy gold like a stock without worrying about the purity and where to keep it.
Sure.
So this brings me to my next question, Vivek. I'll come to you for this. Could you break down for us the difference between physical gold and gold ETFs in terms of cost and taxation?
Basically, if we have to look at cost and compare a physical gold versus gold ETF, we can broadly look at three buckets. First is the upfront buying cost, which in terms of physical gold involves GST of 3%. And plus, there are making charges, which can be anywhere between 5 to 15%, depending on which form of physical gold you're buying, whether it's coins or bars or jewelry. In terms of gold ETF, how this works is there's a broking account that you are opening. So there'll be some demat opening charges. Then there is obviously the broking fee that is taken. And there might be some spreads over and above what the underlying value of the gold is. The second cost is the holding or the maintenance cost. In case of physical gold, you will obviously want to store it in a safe place. So bank lockers are usually where you use this. And so the locker rent is part of it. Also, there might be some insurance cost because sometimes people don't realize that banks are only insuring your value of assets held up to 100 times the locker rent, which might not be sufficient a lot of times. Whoever wants to keep their gold safe might want a insurance on top of it. In terms of the gold ETFs, how this works is there is an expense ratio which might be on an average between 0.5 to 1%. And this includes everything from the fund management to the storage and safety of the gold that is being bought physically by the fund house. And lastly, there is the exit cost, where in terms of the physical gold, if it's especially stored in the form of jewelry, there might be melting losses because you are only getting the cost of the gold back. So even the making charges or GST that you had paid is a sort of a loss to you. In terms of gold ETFs, it's the brokerage and the spreads again, which are usually less than 0.5 to 1% overall, as we see. And finally, in terms of the taxation, so while physical gold is treated as a long-term asset after 24 months, the gold ETFs are treated as a long-term asset after 12 months. And till they are short-term assets, the taxation is as per the individual or the buyer's tax slab. And once they are treated as long-term, it becomes 12.5% tax rate. So here clearly gold ETFs have a edge in terms of becoming long-term faster, so having a lower tax just after 12 months of holding.
Okay, that's interesting. It's just not about convenience, but also efficiency. Even small investors can save on those hidden costs they otherwise don't calculate. Okay, Chintan, I'll come to you with this. When did India first see the introduction of gold ETFs, and how have they evolved in popularity over time?
So, if I think from an India perspective, gold ETFs have been there for almost 2 decades now. It was launched way back in the 2000s when we had the first rally in gold, when gold rallied smartly from 2002 to 2011. And somewhere in between, the golds were launched. But the market size itself, in terms of the mutual funds, was smaller. The awareness of mutual funds was much lesser. So, the gold, let's say the AUM in gold ETFs wasn't significant. It's only in the last 3, 4 years, much like how the mutual fund industry itself has grown to a 75 lakh crore industry, out of which gold is still a very small percent. I think gold plus silver account for less than 2% of the mutual fund industry still. And while it has grown in absolute terms to a more than 1 lakh crore industry, in relative terms, it is still small. So it's been almost 2 decades since which gold ETFs have been available. Silver ETFs were first launched somewhere in 2022, January. So that has also done well for the investors. But gold has been there for a longer period of time. And I think as awareness about all the benefits that Vivek mentioned increases, and as the people move towards financialization of the erstwhile physical savings that they used to do in gold, I think this AUM will typically pick up meaningfully because it's just convenient from an investor standpoint to do so. Because while gold ETFs you buy on the exchange, there are gold ETF fund of funds also where you can do SIPs very easily, and SIP is a way of life. So while people traditionally do SIPs in equities, they pretty much can do SIPs in gold also through the gold ETF fund of funds. or even in gold ETF, they can do it on the exchange very easily every month if the broker platform provides you that opportunity. So I think gold ETFs have been there for long, and from an investor standpoint, it is something which you should have for the long term as well. Thank you.
Vivek, we often hear that gold acts as a hedge against inflation and currency movement. Could you explain how that really works and whether gold ETFs mirror that benefit for the investors?
Coming to the second part of your question first, essentially, gold ETFs are, as Chintan also mentioned, completely backed by physical gold. So, in terms of price movement, they mimic the gold prices one to one. So, whatever purpose gold is serving, gold ETFs do the exact same thing. And now, essentially, looking at how they are an effective hedge against inflation and currency movement. So, firstly, on the inflation aspect, gold has always been seen as a store of value, as a safe haven. And since the time the world moved towards paper currency, essentially, the inflation eats away into the purchasing power of the currency. It is intuitive to know that if I have 1,000 rupees today, it's not the same purchasing power 5 years later. So essentially, holding the same cash in gold sort of preserves the value of the currency or liquidity that you're holding in terms of purely inflation. The second part is the currency movement, which we can look at it in two sub points. One is the regular depreciation that we see in the rupee dollar scenario, which on an average is somewhere around 2 to 3% a year. And essentially, gold prices are it's a global commodity, so are derived from the dollar value of gold, which is then converted into rupees using the USD INR exchange rate. So essentially, anyone buying gold in India is getting hedged against the rupee depreciation that is happening annually. And the second part is the overall currency movement that might happen from a global perspective. This is especially relevant when the uncertainty in the context of geopolitical setup is higher, which can in fact lead to economic slowdown or high inflation sort of worries. In fact, this year we have already seen in the first half, we saw the sharpest decline in USD of about 11% that we've seen in over 50 years now. Likewise, we are seeing even the central banks look at gold incrementally to sort of maintain the value or act as a hedge of their foreign currency reserves. So essentially, that's how gold's overall role is in terms of acting as a store of value or a real asset for an investor.
Makes sense. In uncertain times, gold ETFs can act as a stabilizer in one's portfolio.
Right.
Okay. Chintan, many investors get confused between gold ETFs and gold funds. Could you clarify the difference for us?
Sure, thank you. So, gold ETFs, as I have been explaining, would require you to have a demat account and you go on the exchange and buy it in unit form. So, you can buy 1 unit of a gold ETF and you can sell 1 unit also should you require. So, you need a demat account, a trading account, you go on the exchange, you get them on the demat. But there are many investors who, for regulatory reasons or otherwise, don't have demat accounts. For those investors who don't have demat accounts, then there is a gold ETF fund of fund or a gold fund as they are normally called. What is a gold fund? A gold fund is nothing but a mutual fund which feeds into a gold ETF. In other words, when your money comes, you invest in a mutual fund, a gold mutual fund. That gold mutual fund in turn is going to buy the units of the gold ETF on the exchange. So you don't have to worry about basically going on the exchange and buying it and having a demat account or a trading account. You simply put the money in the mutual fund, which is a gold fund, and then the gold fund will in turn go and put the money in the gold ETF. So it's essentially a vehicle through which you get access to the gold ETF without having a demat account. And as far as the charges are concerned, the charges are also very nominal because the vehicle which is created, the fund of fund, will have a very nominal charge. So it's not like it will add up to your charges because you're buying two funds instead of one. So from a investor perspective, those who have demat and trading accounts and can go on the exchange and buy the gold ETFs, great, because there is a taxation advantage there. You get it in 1 year. In other words, you get the long-term tax benefit. As Vivek was mentioning, if you hold it for more than 12 months, you get a benefit of 12.5% long-term capital gains tax in gold ETFs. While in gold funds, you are getting access to the gold ETF, but because it is not listed, it is a mutual fund, you have to wait for 24 months in a gold fund to get the benefit of 12.5% long-term capital gains. You still get the benefit, but your holding period increases to that extent. So to put it in a summary form, a gold fund is nothing but a fund which is investing in gold ETFs. You don't need a demat account to invest in the gold fund. Just that the taxation of the gold fund is 24 months from a long-term capital gains tax perspective versus a gold ETF, which is a 12 months. So preferred for the investor is gold ETF. But for some reason, if you don't have a demat account, don't want to trade, and you are a long-term investor, then the gold fund also works well. And similarly, the silver fund also works well from a silver ETF perspective.
So ETFs are a more direct route, while gold funds are more for those who want exposure without dealing with the exchanges. Vivek, digital gold has also become quite popular through fintech platforms. How is that different from gold ETFs?
Sure. So again, the idea of the proposition is similar in terms of giving convenient access to anyone. So as Chintan was also mentioning, a gold ETF requires a demat trading account setup. Digital gold does not require that. You can simply use one of the apps or website to create your account and start investing in it. In terms of convenience, there is also some minor differences like a gold ETF would require minimum 1 unit, which may be somewhere around 100 to 200 only. But in a digital gold format, it's just a rupee that you can start with. There'll be trading hours which are applicable to ETFs, which is 9:30 to 3:30. And in case of the digital gold, it's any time that you can do it. If one wants to look at conversion to physical gold, an ETF would be a more indirect route where you have to sell the ETF and buy physical gold from some jeweler or wherever one does it from. In terms of digital gold, the apps and websites do provide an option to convert it directly to a gold coin or a bar or something. So essentially, digital gold tries to add an edge in terms of accessibility and convenience to the whole proposition of buying gold digitally. However, one more key difference is in terms of how the regulatory setup is. In terms of gold ETF, there is a very well defined structure under SEBI in terms of how the overall scheme has to be operated by a fund house and how the reporting has to be done to an investor. In the context of digital gold, there is still a gray area. There is no direct regulation by RBI or SEBI, and hence ETFs have a strong edge here in terms of the transparency or safety that they add to buying gold digitally. And of course, then there is the taxation difference, which is similar in terms of how we covered for physical versus gold ETF, where gold ETFs have being traded on the exchange have the benefit of being classified as long term in 12 months, while for digital gold, it takes 24 months. So your holding period increases. And the cost differences are also similar. Digital gold will incur making charges and the storage, insurance, GST, everything is built into the cost when you are buying a digital gold versus gold ETF, which has a total expense ratio which is up to 1%. So the cost difference is again higher when you're looking at digital gold in the context of somewhere around 5 to 15%, while for gold ETF it will be up to 1%.
Let's talk gold prices, Chintan. Gold prices are already extremely high. Many investors wonder, is it too late to enter? So, how much gold should ideally be part of a well-diversified portfolio?
So, Ankita, we've done many shows through Outlook, and thanks Outlook for all the effort that they did in terms of popularizing gold and silver way before many people did. So I remember doing it 2, 3, 4 years back and giving the entire outlook in terms of, if you look at the world, the global debt is $300 trillion plus, the global equity markets were $100 trillion plus, and the gold markets, which is obviously a store of value and the more than 5,000 years history, was only about 11 to 12 trillion dollars at that point of time. So much money had got printed that, but money concentrated itself in equity and debt. And from 2011, when gold peaked till 2020, gold prices gave zero return. So it was a very easy call that at some point of time gold would do well. We only had to have patience. And then courtesy whatever was happening geopolitically and otherwise, and also the the dollar depreciation, which Vivek mentioned, and the expected dollar depreciation to continue in the long run because US obviously is in a debt trap of its own. Gold prices have gone up from the lows of $1,100 somewhere in 2015-16. They went to $2,000 in 2020, which was the 2011 peak. And once they crossed the 2011 peak in 2021, they are now almost at $4,000. They've crossed $4,000 for the first time. We don't know what will happen in the future because prices are unpredictable. But what we know is from an investor construct perspective, equities have also done well in the last 10 years. Debt is an asset class which probably may not be able to beat inflation given that prices are going to rise because 2010 to 2020 was a period of low inflation, low growth globally, but 2020 to 2030 and beyond, because now China, the cost of manufacturing is increasing meaningfully, the cost of services also increase meaningfully. Inflation is going to be much higher globally, and we are seeing that across the world. And interest rates will also probably be higher. So in that sense, you still need to have gold. In my last discussion on gold plus silver, I probably must have mentioned that you need to have 15% in gold plus silver. Given the sharp rally of more than 60% that silver has had and 50% that gold has had in the last 1 year, I'm now saying that we can go back to the normal 10% exposure to gold plus silver as a part of the portfolio. That 10% still should still be there because all the other asset classes like equity and all are also not very cheap. So just to hedge yourself, which we beautifully explained, that gold does act as a hedge against inflation and also a hedge against a potential global uncertainty. Gold should be 10%. Gold plus silver should be 10% of your portfolio now versus what probably would have been 15% when I last spoke. So I'm reducing the exposure level, but still 10% should be there because the world is still uncertain and we can't put a price that this is the peak or this is, where it will stop. We don't know. So 10% allocation, and then we should be comfortable with that, holding that for the long term. Thank you.
And that's extremely helpful for the investors, 10% exposure to your portfolio. So Vivek, younger investors often prefer equities and crypto to gold. Okay, so 10% exposure, we understand. Does it make sense for them to add gold ETFs to their portfolios, even if not for festive reasons?
Sure. So, festive reasons were anyway like a traditional way of building some recurring, consistent form of investment into gold, whether it's Dhanteras or Akshaya Tritiya or some other festival that it's linked to. But the idea behind this was very sound in terms of having like a consistent exposure that you are adding to in terms of gold. While we don't believe that one needs to time it in terms of linking it to any event, but the role of gold is sound in the portfolio where it acts as a stabilizer or adding safety in terms of where your portfolio is. So we ideally look at gold in two terms. One is the strategic allocation, another is the tactical allocation, which in some way Chintan was also mentioning, where 10% is what your strategic allocation can be. It's a long-term steady state allocation, which is essentially meant to add that layer of stability to your portfolio in the long term. And tactical allocation is where you be more opportunistic, where you're seeing that it's not done well over time. So there you can add. Or when times are more uncertain and you are a more conservative investor, so you want to trim your exposure in the more aggressive assets that you might be holding. So at that time, gold can add as a very good diversification tool.
Okay, so ETFs are just not for traditional investors, they're a modern diversification tool for millennials. So, Vivek, what are the risks that investors should be mindful of when investing in gold ETFs?
Right. So the most important risk actually is about holding gold as a asset class only to sort of understand the price volatility in it. But it is more so in the context of a gold ETF because it is held not in a physical form, but in your trading account, where a lot of the people have an inclination to open it daily or weekly or at a high frequency and sort of track the prices. So one needs to understand that gold acts as a stabilizer in the long term. But there are ample instances in history where it's fallen more than 10% in a year. In fact, as Chintan also mentioned about 3 or 5 years ago, gold returns have been very suboptimal because of almost a decade of underperformance. So essentially, understanding and appreciating that short term might have that volatility is very important when one is getting into gold ETFs. Then, of course, specific to the ETF platform, while now the AUM is much higher and much more comforting for a retail investor, there is obviously the liquidity or market risk that comes with it. Since ETFs are traded on the exchange, it's linked, the prices are essentially linked to not just the underlying gold or silver price, but it's also linked to the demand supply on a particular day. As we saw, in fact, in the last week, where physical silver supply was an issue. So even though silver prices have themselves not rallied to that extent, the price of the ETF was at a premium of almost 10% or higher in some cases. So a good practice for an investor is to search for the particular scheme's INAV, which is the real NAV, which sort of gives them a guidance in terms of what the real value of silver or gold is in the underlying ETF. And then, of course, when they are picking a scheme, they need to be mindful of looking at tracking error. Essentially, while the scheme is simply buying gold or silver, there is a slight execution risk that one needs to be mindful of. That's why we usually look at larger fund houses which have a AUM of say 5,000 or 10,000 crore plus, where these challenges are lower. And finally, there might be some regulatory risks that one might need to be mindful of. The tax treatment, for example, right now is different between a gold ETF and a physical gold or digital gold or even a gold mutual fund. So there might be sometime in future where the government looks to align it and bring everything at par. So to that extent, an investor might need to be mindful of that.
Chintan, what are some of the common mistakes that you see investors making with gold ETFs?
I think Vivek already highlighted one of the common mistakes is basically because it is so easy to access and more importantly, so easy to get out. At the first 10, 15, 20% rally, people tend to get out. So to that extent, having an asset allocation plan helps to avoid these kind of mistakes. You may have a target price in mind where you want to lighten, that's fine. But if in your overall portfolio, you have a certain percentage in mind, it always helps to make the right decision. So the most common mistake is to basically get in too late, or rather most people may be looking at gold and silver right now as an investment and not looked at it 3 years back, or selling too early. If you are able to avoid selling early or getting into late, in most investments, you will not probably have a difficult time. So I think the most common mistake would be that everything else is fine as long as you do the right things. But selling early and getting in late are two things which you must avoid, not only in gold, but in every investment that you make. So that should be something which you should always keep in mind.
Okay, so it's still a market-linked product. Discipline and patience are key. Um, Thank you so much, Vivek and Chintan, for joining us today. This has been a very, very insightful conversation.
Thanks a lot, and Shubh Deepavali to all the viewers and to you as well, Vivek and Ankita. Thank you.
Thank you so much. A very happy Diwali to all the viewers and to Chintan and Ankita also. Thank you.
So this Diwali, while we all love the sparkle of gold, maybe it's time to think beyond ornaments and consider investments that can truly build wealth through gold. Thank you for joining us today. Stay tuned to Outlook Money for more such conversation. Wish you a very prosperous and sparkling festive season from Outlook Money.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.